Alright, hello and welcome to Camel Finance. I'm your boy Camel, and today I'm going to be going through some mathematics that shows you the USA is insolvent. Let me say this one more time. The USA is insolvent, and I mean that today. It is insolvent today. So, first of all, what does insolvent mean? Insolvent, of course, means unable to pay the debts owed. So how does the US government end up acquiring debt? The federal government borrows money by selling marketable securities such as treasury bonds, bills, notes, floating rate notes, and tips. Said another way, it issues bonds. As of the time of recording, the US currently has just under 30.9 trillion, with a T, US dollars of debt. So the total debt on the planet is 400 trillion. Global equities are around a quarter of this. Total global assets is around 900 trillion. So pretty simple maths tells you that the debt is 4/9 of global assets. Said another way, almost half of global assets are debt. The USA takes in 4.8 trillion in tax revenue, and this includes capital gains tax, which will of course be bad this year. They will be taking in significantly less capital gains taxes this year because people will not have made as much money, anywhere near as much money, due to the market conditions, due to the bear market in stocks and crypto. So the US takes in 4.8 trillion in tax revenue, and ordinarily 3.6 trillion of this is allocated to entitlements like social security, pensions, so on and so forth. 0.8 trillion or 800 billion is allocated to military spending. So 4.8 trillion in tax revenue minus their 4.4, the sum of these two, mandatory allocated expenses, leaves them with 400 billion or 0.4 trillion left to pay the interest on their 30.9 trillion of debt. So of course this is a massive problem. Stick with me because it only gets worse. The average interest expense used to be slightly over 1%, but the US 10-year rates are at 3.4%. So this is why I often use this chart. You can see back here around April of 2020 through to say November of 2020, we were sub 1%. We crossed above the 1% threshold in January 2021, and since then, as of Friday's close, we are at 3.451% on the US government 10-year yield. So the USA needs to keep issuing new debt to pay off the debt that's being matured, i.e. they keep rolling over the debt. If no one from overseas wants to buy this debt, then the central banks have to. It's the central banks that have to buy this debt. They have to buy these bonds if no one from overseas wants to. So let's just pause here for a moment and ask ourselves, if you're an overseas investor, if you are the Saudi Arabian government, if you're a sovereign wealth fund, would you buy a bond yielding 3.4% when inflation in the currency that bond is settled in, the dollar, is on an 8 handle, according to their CPI metric? Of course, the real world is on a 16% handle minimum. So you are guaranteed to lose at least 12.6% a year, at least, by buying this bond. Would you, as a money manager or a sovereign wealth fund guy, would you buy this sort of thing? Would you buy this type of debt? And of course, as the rates increase, the bond price, which is inversely proportional to the yield, decreases, meaning your initial purchase price of the bond is also losing money as they continue to hike these rates. So of course nobody would do this, and this is why we're seeing places like Saudi Arabia, they are dropping their treasuries to 4-year lows. This was as of December 2021. Here in April of this year, you could see that they have reduced 36.7% of its holdings in US Treasury securities in just 2 years. They are dropping these bonds. It's not just the Saudis. Japan, China cut holdings of US Treasuries to multi-year lows. And ultimately, this is why cutting US Treasury holdings shows falling confidence in the dollar. And it goes right back to what I just said. Would you buy a bond yielding 3.4% when inflation is on 8 or a 16 handle, depending on whether you accept their CPI data or whether you know about the real world calculation? So as these overseas investors, as these sovereign wealth funds, as these governments and central banks from around the world are refusing to take on this debt, the central bank of America has to buy it. So here is the real problem, and if you have forgotten the numbers or anything, I've created a summary down here, so just stick around for 1 second while I wrap this all up and tie this together. Here is the real problem. What if the interest rates that they keep hiking go from 1 to 3%? as they did when I showed you the chart earlier, and Friday's close being 3.45%. Well, now their interest obligations are over $1 trillion per year. But we only had 0.4 trillion or $400 billion to start with. They are running over $600 billion of debt that is growing because of the contractual obligation of the bonds. So here is the maths in summary from the beginning. The USA takes 4.8 trillion in tax revenue, including capital gains tax, which of course we know is going to be bad this year. 3.6 trillion of this is allocated to entitlements, social security, pensions, etc. And 0.8 trillion is allocated to the military spending. So 4.8 trillion minus the sum of these two here is 400 billion left, or 0.4 trillion, left to pay the interest on their 30.9 trillion of debt. The interest on their bonds is more than $1 trillion a year, meaning they have 600 billion of growing debt. If this was a household or a business, they would be wrecked. Okay, the technical term for this is of course insolvent. Nobody in a household or a business would ever be allowed to operate like this. No one. They would never allow you to operate a business or run a household under these sorts of conditions. And remember, all of the above calculations are based on a 3% yield. But it's not 3%, is it? It's 3.45, as I showed you from the chart, as of Friday's close. Meaning it's actually 1.2 trillion of interest that they have to honour and 800 billion of growing debt. And of course, as they continue to hike rates, these numbers only go up and up and up, right? So this is why all paths lead to more QE, more money printing, and a pivot on hiking rates. And I think sooner rather than later, I'm going to show you exactly why I think that. They have to inflate the debt or never pay it back. And it keeps getting worse. Never paying it back is not really an option. The reason for this is this would cause World War III, wouldn't it? If you are a sovereign wealth fund in Saudi Arabia or Japan or China and you have bought US monetized debt in order to receive a yield, and then the US just decides, we're not going to pay you a yield, it's likely going to cause war. This is not an option to just cancel this debt. So the only choice they have is to inflate this debt away. And I know what some of you might be thinking, but Camel, won't the Fed keep hiking like they say they will? Won't they keep raising interest rates? Well, maybe. But if 3.45% yield currently equals over 1.3 trillion in annual interest, and they hike rates to 6%, like some people are saying, I've even seen people calling for 9%, but let's stick with 6% now. Let's say they are hell-bent on hiking rates and they're going to hike to 6%. Well, now the interest rate is north of 3 trillion a year, and the markets crash more, which means capital gains taxes go down even more. They're even more broke. This is not an option. This is not something they can continue to do. They can pretend like they want to fight inflation. They're very good at standing there and telling everyone, we're going to hike, and we don't care about anything else. We just need to get inflation under control. But this is why I've been calling for a pivot around September and October. For as soon as they started to hike rates, I knew that they were bluffing with this. Now, of course, I can turn out to be wrong, but simple math tells us that this cannot go on for much longer. Bitcoin is not just a hedge against inflation. It's a hedge against central bank blow-ups. It is over for the US. How can you look at these numbers and come to any other conclusion? It is completely over for them. They have no choice but to hyperinflate their currency or default on their debt. Defaulting on their debt would cause massive, massive chaos, wars, all sorts of enormous problems. It's not an option. The only option is for them to start to lower rates pretty quickly and then start to print more money to try to service their debt, make their debt more serviceable by inflating it to nothing. So the Fed has always been very good at convincing the markets of one thing when actually the other was true. Inflation is transitory is one of the best examples I can think of at the moment. According to polls and surveys, 70% of the market participants believed that inflation was transitory because the Fed said so. There was to people that understood Bitcoin, to people that understood QE, to people that understood the bond market, this was never, ever, ever a question of whether or not it would be transitory. It was always going to be sticky and prolonged. The Fed also recently has been telling us that despite having 2 quarters of negative GDP growth, this recession no longer identifies as one. And I really truly believe, and of course I'm open to being wrong, I could be proven wrong if we don't get a pivot in the next couple of months. But I really truly believe that we're about to see the same thing with the Fed, with regards to hiking rates. I really truly believe that it is over for them. They can't continue to hike rates. And I think largely a lot of what they were doing with these current rate hikes was nothing to do with getting inflation under control, but was rather hiking these rates so they have something to lower again. Now, of course, they're going to go to a pause before they lower. And maybe, if I'm really, really wrong on this, they're going to continue to hike all the way through to January, February, March. But personally, I think it's completely over for them. You've seen the calculations. There's no way they can continue to hike north of 4, 5, 6%. There's no way. And I'm seeing calls of 9%. I just don't see how they can do it. Of course, this could always be a controlled demolition. Maybe they're going to blow everything up on purpose so that they can reset the system with their new CBDCs. That remains to be seen. But for now, I think it's safe to say that the only thing that is safe to hold is Bitcoin. I'm not suggesting anyone put all of their money in Bitcoin, but do not save into the dollar. Do not save into a bank when the central banks are operating in a way that would never, ever, ever be allowed for a household or for a company or a business or a corporation to operate. Bitcoin is not just a hedge against inflation, it's a hedge against central bank blow-ups. If you found value here today, I'd appreciate it if you could drop a like on the video. Subscribe if you're not already. If you want to see any technical analysis charts, live trades, setups, that sort of thing, then see yesterday's video or come back tomorrow. Got a feeling about Monday. Monday is going to be kind of bullish, and maybe I'll turn out to be wrong and eat my words on this. Wouldn't be the first time I've been wrong, of course. However, the VIX refusing to spike kind of tells me that there's potentially some risk on the closes. The fact that we wicked down and then closed higher across markets tells me that this was not a panic sell-off on Friday. So that remains to be seen. I'm hoping that we can get some sort of bounce on Monday and then we can entertain some more longs. If you're interested in seeing more content like this or more live trades from me, then make sure you hit that subscribe button and turn the notifications on. In the meantime, enjoy the rest of your day. All the best from me. Take care. Cheers.